Listen to me, my friends. You worked 40 years, you saved, you sacrificed, you did everything right, and you built up a healthy, high-income nest egg. You think you are home free, right? Wrong. Because if you are not careful, Uncle Sam is standing right at the finish line ready to take a massive chunk of what is rightfully yours. The biggest mistake high-income retirees make is assuming that once you stop working, your taxes automatically plummet. I hear it all the time, Susie, I won't have a salary anymore, so why would I be in a high tax bracket? Sweetheart, if most of your wealth is sitting inside traditional 401(k)s, traditional IRAs, and deferred compensation accounts, you do not have tax-free wealth, you have a massive tax debt waiting to be collected. Every single dollar you pull out of those traditional retirement accounts is taxed as ordinary income. Here is the fear that keeps so many smart retirees awake at night: losing control. You spent a lifetime controlling your money, but when you hit your required minimum distribution age, whether that is age 73 or 75 under current laws, the IRS tells you exactly how much you must take out, ready or not. And if you have saved $2 million, $3 million, or $5 million in tax-deferred accounts, those forced distributions will push you right back into the highest federal and state tax brackets. On top of that, up to 85% of your Social Security benefits become taxable. And it gets worse, because there is a stealth tax that almost nobody talks about until they get hit with the bill, IRMAA, the income-related monthly adjustment amount. If your modified adjusted gross income crosses key thresholds, the government slaps a massive surcharge on your Medicare Part B and Part D premiums. And guess what? IRMAA looks back at your tax return from 2 years prior. So a large withdrawal or a big capital gain today can blow up your healthcare costs 2 years down the road. Just $1 over a threshold line can trigger hundreds or thousands of dollars in extra Medicare costs per year. That is absurd, but it is the reality, so you must wake up to it. So, what is the question you need to be asking yourself right now? The question isn't, how do I pay zero taxes? The real question is, how do I take control of my tax brackets today so the IRS doesn't control my retirement tomorrow? Here are the actionable takeaways you must execute immediately to protect your hard-earned wealth. First, take advantage of your gap years. The gap years are that golden window between the day you retire and the day your forced RMDs or Social Security kick in. During these years, your earned income drops, which means you may be in a lower tax bracket than you will be once RMDs start. This is your moment to execute partial Roth conversions. You intentionally pull money out of your traditional IRA, pay the tax now at a lower, known rate, and move it into a Roth IRA where it grows completely tax-free and is never subject to mandatory distributions during your lifetime. Doing this systematically shrinks the size of your future forced RMDs and lowers your future taxable income. Second, master your withdrawal sequencing. Stop pulling money randomly. You need a strategy that balances withdrawals from 3 distinct buckets: taxable accounts, tax-deferred accounts, and tax-free accounts. By carefully filling your tax brackets up to a specific limit each year without jumping into the next higher bracket or triggering an IRMAA cliff, you smooth out your tax burden over decades rather than taking massive tax hits later. Third, if you are age 70 and a half or older and you donate to charity, you must use Qualified Charitable Distributions, or QCDs. Instead of taking money from your IRA, paying tax on it, and then taking an itemized deduction, you send the money directly from your traditional IRA to a qualified charity. That money counts toward your required distribution once RMDs begin, but it never shows up in your adjusted gross income. That keeps your AGI down, helps protect your Medicare premiums from IRMAA surcharges, and supports the causes you love completely tax-free. Fourth, mind the IRMAA brackets constantly. Work with a CPA or financial planner who looks at multi-year tax projections, not just last year's return. Every financial decision you make, selling a property, harvesting capital gains, taking a big distribution for a dream vacation, must be evaluated against its impact on your tax brackets and Medicare surcharges 2 years later. Do not let the IRS become the primary beneficiary of your estate or your retirement plan. You earned this money, you saved it, and you deserve to enjoy it with total financial peace of mind. Get active, get informed, and take control of your financial destiny today.